The Ultimate Trading Strategies Masterclass. So a little bit of information about myself. I'm a professional trader, author, speaker, and entrepreneur. I founded MultiTrader because I believed in create a community on where we can all learn how to trade, master trading, and then all grow our wealth together the right way, the realistic way. At MultiTrader, we specialize in helping you learn how to trade well and make a success from the financial market. We have shared the 4 main principles of successful trading to over 257,000 plus members since 2003. The 4 main principles are markets, methods, money, and mind. So at the end of this masterclass, you will know, trading in a nutshell, what, why, how, when. 2 ways you can make money trading, how to make money in a falling market, the best chart type and how it works, top trading markets, trends, times, levels, and outcomes, and the most important, 5 best trading strategies. So the moving averages, crossovers, and swing, RSI analysis, overbought, oversold, market environment, and bullish and bearish divergences, 24 candlestick charting formations revealed, range-bounded trading, 24 powerful breakout patterns explained, and so much more. So before we begin, I need you to know that I'm going to go through the basics very quickly. This is an ultimate masterclass so that from the ultimate beginner can actually understand up until the part where we start doing more intermediate to advanced tips. And the focus is around the 5 best trading strategies. So make sure you stick around because these are strategies I have briefly revealed, but not to the extent that I will be doing it today. It's the first time that I'm actually revealing these strategies. And best of all, I'm so happy that you're with us today to enjoy. Masterclass Lesson 1. What is trading? Trading in a nutshell. Financial trading is buying or going long and selling or going short different markets to make bets for financial gain on short-term price moves. So you either buy or go long, where you anticipate that the price will move up, where you will bank a profit at a higher price and realize a gain. Or vice versa, you can sell or go short, where you expect the price of the market to drop, where you will buy back the derivative CFDs, whatever you're buying back at a low price and realize a gain. So that is trading. It is making a simple bet. But more importantly, financial trading is one big auction. There is demand, there is supply. When there is a lot of demand, there is buying. When there's a lot of supply, there is selling. And because human psychology will never change is the reason why financial trading inevitably will be the same. There will be trends, the markets will move up, will move down, and will move sideways, which means that when the markets trend, we have the perfect opportunity to follow the trends and profit at the same time. Masterclass Lesson 2. There are 2 ways to make money trading. So the first way is to buy low and to sell high. So you buy a price at a low level, you wait for the market to move up, where you'll bank at a higher level for hopefully a profit. Or you will sell high or go short, where you anticipate that the market price will drop, where you will buy it back at a low price for a profit. I'm building this up to information that I've never revealed with all the trading strategies that you've been wanting to know so bad, with high intensive explanations on how the strategies work. Masterclass Lesson 3. Make money in a falling market. What is short selling? Short selling is where you sell or go short an underlying market at a high price and then anticipate a drop in price, where you'll buy it back at a low price for a profit. And here is how it works. So we're going to use a South African company called BHP Billiton Group, or BHG for the ticker. and the share price was at 453 Rand and 49 cents. We expected the price to drop to 410 Rand. This is a trade we sent out to Premium Multi-Trader service. So with short selling, you bet down. I expect that the market price will drop. And because we've had a bit of a bear market lately, with the US entering into a recession with inflation rates of over 9.1%, which is the highest rate since 20 years ago, because we have interest rates that are increasing, there is a looming idea that the market is going to continue to drop and there is going to be a bear market from here. So here's how it works. So you're going to short it at a certain price. You're going to expect the price to drop. So the short sell entry price is 453 Rand and 49 cents. The market then does drop to around 410 Rand and hits our take profits. And between where we shorted or sold and where we bought back is where we make a profit or a gain. Let's look. So there is a market maker, which is a company, a broker, and there is a short seller, which is you. So with derivatives and with trading, it's between you and the market maker, or between the market maker and you. You're not buying and selling to some other guy who's in his basement buying and selling shares. You're actually betting against the market maker each time. So it's almost like the casino. So you sell or go short 20 BHG CFDs at 45 Rand and 34 cents per CFD, and you are exposed to 9,069 Rand 0.80 cents. Just so you know, this is a South African currency. So you are exposed to 9,069 Rand and 80 cents when you buy 20 CFDs, where 45 Rand 0.34 cents per CFD will give you exposure to one BHP Billiton Group share. All right. So let me say that again. The share price is at 453 Rand and 49 cents. And the CFD is you will pay 45 Rand and 34 cents to be exposed to the share. And you're buying 20 CFDs, which means that you will gain exposure to 9,069 Rand and 80 cents worth of BHP Billiton shares. Then the share price drops. So you sold or went short at 453 Rand and 49 cents. The share price drops to 410 Rand. And that's where you buy back the 20 CFDs at 41 Rand per CFD this time. So it's less, which has a new exposure of 8,200 Rand. You return the 20 exposed shares to the broker or market maker, and you bank the difference of 869 Rand and 80 cents. So you're basically taking the old exposure, which is 9,069 Rand 80 cents, minus 8,200 Rand, and you bank the difference, which is 869 Rand and 80 cents. When you sell or go short at a high price, for example, BHP Billiton Group, you are borrowing shares from the broker. Then once you've borrowed the shares and the share price drops, then you've got to buy back the shares to make your position neutral. And because you're buying it back at a cheaper price, you are banking the difference, which will give you a profit. All right, so that's how short selling works. In order to determine where a market's price is more likely to go, traders use charts through technical analysis. Masterclass Lesson 4, the best trading chart to use. Let's start with how a basic line chart works and then head over to candlesticks. So here's a price chart, which is a line chart. And as you know, each chart has a vertical price, which is the price of the market or financial market, and the horizontal part of the chart, which is the time. So it can be a tick, can be a second, can be a minute, 30 minutes, hourly, 4 hour, daily, weekly, monthly, yearly, whatever time frame you choose or time period, that is what it will show on the horizontal time. And the vertical price is what prices will show at the time of buying a market, the close price, open price, the low price, the last price, whatever you choose. And what happens in between is the movement of where us traders make or identify and distinguish chart patterns, indicators, certain movements, and we make probability predictions on where it's more likely to go. And that's when we place a bet for buying or selling. So the market can move up, can move down, and can move sideways. But I have a problem with the line chart, and that it fails to show the entire market activity, which is the buying and selling prices during the chosen time period. So the solution is candlesticks. Each candlestick has an open, which is the first traded price for the time period, has a closing price, final traded price for the time period, has a high price, which is the highest traded price for the time period, a low price, which is the lowest trading price for the time period. It also has a body, which is a thick part between the open and close of the candle. And then it has a wick, which is the thin part between the open, close, high, and low. So each candle has a wick in general, and same with trading chart candlesticks, the wick is also the thin part of a candle, where it does not constitute of the body. Masterclass lesson 5, 3 types of candlesticks. So you have the up candle, the down candle, and the doji. The up candle is basically where the open price, which is at the bottom of the candle, is lower than the closing price. And between the open and closing price is the body. There is also the wick between the open price and the low, and there is a wick between the closing price and the high. And what tells you that the market is moving up is the color. So because I choose green, some people choose blue, others choose white, others choose red. I don't know why, but anyway, I choose green because I think of, in the money, dollar. The up candle has a body, in my case, of green, which tells us that the market is moving up. Then we have the down candle, where the open price is higher than the closing price. The body is in between the open price and the closing price. And because I choose red, it means that it's a down candle where the candle closed at a low price and where it opened at. Then there is a wick, which is in between the open price and the high price, and between the closing price and the low price. And then finally, we have a doji. A doji is where the open price is equal to the closing price. There is no body. Then there are the candlestick patterns, which we will go through later. Masterclass lesson 6, top markets you can trade. So what markets can you trade? The first ones is that you can trade equities, which is also known as stocks or shares, and you can trade local and international shares. Then you can trade indices, which is, for example, the All-Share JSE Top 40 Index, the S&P 500, the DAX, the CAC, the ASX for Australia. Then we have currencies, which is Forex, where you can trade the euro, the dollar, the pound, the yen. You can trade major currencies, minor currencies, exotic currencies. You can also trade commodities, oil, gold, coffee, platinum. You can trade different cryptocurrencies as a financial market, Bitcoin, Dash, Litecoin. You can trade Bitcoin Cash. You can trade Ethereum. Masterclass lesson 7, 3 top market trends. So as we've mentioned before, there are 3 types of trend lines. There is an uptrend, which has a support line where a line is drawn from the low prices of the charts. It has a positive slope. There are higher low prices using both the body and the wicks of the candle. So a lot of people ask me, where do you put the trend line? Do you put it at the bottom of the wick, the open price of the candles in an uptrend? And to answer that, I always say both, because sometimes the wick is a bit of an anomaly, and you wouldn't be able to put the trend line because one little wick decided to trade all the way at the bottom, which interfered with it. So I always take the bulk of the movement between the open price of the candle and the wicks, and I choose the majority of where it's trading at to create some type of regression uptrend line. So in this case, we use higher low prices. And finally, it is connected with at least 3 low points. So the more price touches, the more valid it is. with an uptrend, I always make sure that it's established after 3 low points. The market is more likely in an uptrend, and I will follow the market than go against it. Then we have the downtrend line, which we'll be using a resistance line. A resistance line is a line drawn from the high prices of the chart. There is a negative slope where the market is clearly moving on a downtrend. There are lower high prices using both the body and the wicks of the candles. So once again, you're using the wicks and the parts of the body of the candle to establish the downtrend line. And this at the top is known as a resistance line, or what I call a ceiling level to those who have just started trading. And then it's connected with at least 3 high points. The more price touches, the more valid it is. Then we have a sideways trend line. The most important thing is that there are same level of low prices and same level of highs horizontally. When it comes to sideways trend lines, make sure that the trend line is horizontal rather than diagonal, because one price that the market keeps hitting is always stronger than a trend line that is diagonal and it is hitting more levels than one. A sideways trend line also has a horizontal slope. There are parallel horizontal lines forming a rectangle using both the body and the wicks of the candle. Masterclass lesson 8, the 3 trading levels. So with trading, there are 3 main trading levels that you need to watch out for. The first one is the entry level. What price are you getting in? What price are you buying the market or going long? What price are you selling the market or going short? In this case, we are buying going long, as we know that the market is moving up. Second is the stop loss level. Now, stop loss level is pretty much a level or an instruction to the market maker or broker that tells the market maker that if the market turns against you and the prices hits this level, it will get you out because it's going against your trading strategy. However, you can still make profits with a stop loss level. And I do this very often with the Premium Multi-Trader service. The market moves up in my favor, and because it is continuing up on a trend line, I move the stop loss up so that if the market turns against us, we bank a profit. And I do this at least once or twice a month where we lock in profits. And then we have the take profit level, which is instruction to the market maker to get you out of the trade and realize a profit or a gain because the market has moved in your favor rather than against you. So you have the entry level, the stop loss level, and you have the take profit level. Masterclass lesson 9, when you can close your trade. When can you close your trade? First thing, during market hours. So especially with shares, stocks that are local and international, you need to see when the stock exchange opens and when it closes. So with South Africa, it's between 9 a.m. to 5 p.m. for underlying shares. For America, it's 3:30 p.m. to 10:30 p.m. for underlying shares. This depends on daylight savings. Sometimes it's 3:30, other times it's 4:30. It's whenever the clocks change. And then in the UK, it's usually the same time as South Africa, but also make sure that you watch out for daylight savings. Forex, indices, and commodities is a 24 hours a day, 5-day a week spot market, which you can trade. And then cryptocurrencies is a 24 hours a day, 7 days a week spot market, but you do need to confirm with your broker. Masterclass lesson 10, the 5 trading outcomes. Now, there are 5 trading outcomes that you can take with any one trade. The first one is that you can break even, where you do not lose any money or you gain any money. The second one is where you take a small loss in the market when the market moves against you and hits your stop loss. There is a small gain when the market moves for your favor and you bank a small gain. Then you have a big loss where the market either drops past your stop loss, it gaps, you bank a huge loss because you put too much money in. This is a position that you never want to be for a trader. You never want to take a big loss, and you should never expect this in your trading strategy. If you can see that there is a gap in your trading strategy that you can take a big loss, you are then trading incorrectly and you're trading based on greed and fear, and you just want to make the money as quick as possible. Do not ever settle for a big loss. And the only time you should ever take a big loss is if the market does gap and hits past your stop loss and gets you out at a bigger loss than what you expected. But keep following your trading strategy. And then you have a big gain, which is what we need to grow our portfolio to all-time highs. These small gains do keep consistent with making the portfolio trade a little bit up and a little bit down because you're taking small gains and small losses. But when the market does enter into a highly tradable and good environment for trading, these big gains, which does come at least 4 to 6 months a year, is what is going to grow your portfolio, which is why you need to take every single trade that lines up according to your strategy and not base your decisions on your gut, your opinions, what your mom said, what your dog said, what Jim Cramer says. You've got to just follow your strategy and just depend on it, because it's the only thing that you know has a high probability of it working out. So these big gains is what we look out for, and which is why we do not stop trading. Masterclass lesson 11, know your time frames. A time frame shows you the buying and selling prices or market activity during a selected period. So a time frame shows you the buying and selling prices during a selected period. You can choose to view time frames or periods from tick, seconds, minutes, hours, days, weeks, months, and even years. You choose your time frame based on your strategy. From my experience and from my personality, I like to trade shares and stocks using a daily time frame. With Forex, I like to use a 4-hour time frame and daily. However, when it comes to minutes, seconds, and ticks, it's not in my personality to take every trade that comes my way, because the more trades you take, the more losses that will incur. So a daily time frame is where we can take one candle, for example. So let's say that there is a candle that opens at 500 cents at 9 a.m. when the stock market opens. Then the prices move down to a low price of 495 cents, and the price moves up. So there's trading activity or market activity that moves all the way up to a high price of 525 cents. And then it closes at about 520 cents. Okay, so between the open and close formed the body, remember. Between the open and low formed the wick, and between the close and the high formed another wick. And between the entire day time frame or time period, there was a 30 cents range. The daily candle formed, and then what happens the next day, 9 a.m.? The new candle formed with a new open price. So the next day, a new candle will open at a certain level next to the previous candle on the right. It will then form the market activity that will take place to determine what candle forms. So in this case, it is a down candle. And at the end of the day, when it closes, then we will know that it was a down candle, the market is turning down, and it has a higher chance at continuing down tomorrow because supply is outweighing demand. A 5-minute candlestick chart looks almost identical to an hourly candlestick chart and identical to a daily candlestick chart. The only difference, or the main differences, with a 5-minute, the range will be a lot smaller with prices that traded between the low and the high, because after 5 minutes, a new candle forms. There are many 5-minute candles inside a daily candle, which means that the range will basically make up for many of these 5-minute candles within a day to form one candle. So the range is vastly different when it comes to time frames. Here's an example with a market. So Kellogg Co 1-minute chart. You can see that this is an unattractive chart. We are not establishing good trends. There's not good market activity. And these are charts that I avoid by all means, because you can see that in many cases, there was no trading activity within the minutes. And also, what do you do with this? You know, there are so many gaps. So a gap is basically where prices do not trade with between the low and the highs of the candles. There's gaps here. And you can easily, for example, the market's going up, you get in going long, and then the market comes down. Then the market goes up, you go long again, the market comes down. So it's very difficult to trade these low timeframes. I do know people that do trade these timeframes, and they are taking around 50 trades a day. I know some traders that are trading 500 trades a day. They break their keyboards. They throw their mouses across the room. They go crazy. So the question is, do you want to live like that? Probably not. You want to live a more stress-free life, risk-averse. And so these timeframes I avoid. 1 minute all the way up to 1 hour, I kind of avoid. So the reason why is because when you have lower time frame charts, there are more candles to deal with. There are a lot more short-term trends, and there are more trading setups, which means that there are a high number of winners and losers within your portfolio within 1 day. Now let's look at a daily chart of Kellogg Co. And you can see that it looks a lot more tradable and easier to handle. There are medium-term trends, which we can take advantage of. There are less trading setups, as there are less number of winners and losers. And you only need to worry about analyzing charts once per night, where you can end up taking 1 or 2 trades per week. After a number of days, you'll see something like this. A candlestick chart forms, depending on whatever time frame you choose, and you will see that there is market activity. But what you need to understand is that there is a lot going on between these candlesticks, which is what we're going to go through today on how to determine the momentum of candlesticks. With your chosen markets, you'll need to have a trading strategy to follow in order to make high probability calls on where to buy and sell different positions. So 5 best trading strategies. What is a trading strategy? A trading strategy is a method in the financial markets that bases predefined rules and criteria to spot high probability trades and make other calculated trading decisions. So these are the trading strategies that we are going to go through today, and we're going to go through it in a lot of detail. Right. So do you use leverage? Absolutely. Trading is all about leverage. When you are trading shares, you are having the full exposure of shares, and you got to put in a lot more money to bank a lot less with short-term movements. With leverage, you obviously put in less money into trades. You expect the price to move up maybe 2-3%, and you can bank 30 up to 100 to 200% of the margin that you put in with each trade. So if you put in 30 Rand and you bank 100% gain, then you bank 60 Rand. But that 30 Rand is not 30 Rand portfolio. It's 30 Rand of what you're willing to put in based on your portfolio. That is only based on the initial margin or the initial deposit that you put in with your trade. So yes, leverage is very important with trading. I can't think of doing it anywhere else, unless if you become like a medium-term investor, you look at the charts, you follow a weekly time frame, and then you buy local and international stocks. Absolutely. Then you can go with it, and it's actually a good strategy. The investing trader. What is a tick? A tick is the smallest increment movement that a market can move when buying and selling. So instead of looking at a minute chart where there's buying and selling within a minute, each tick is where there is a price. And when someone buys at a certain price, the next price that someone buys or sells will be the next tick. And that's what you were seeing. If you go to a tick chart, you'll just see there is no body in candlesticks because there is only one transaction per tick. To determine the trend, is a line chart better than candlesticks? Yes. Candlesticks basically shows you the activity within a certain time period, and trend line will show you the trends that the market is moving with those candlesticks. So as I showed you before, what we do as traders is we do nothing other than turn the chaos into order. And we do that through confirmation bias, where we are basically putting our own imaginary trend lines and saying that the market's moving up and therefore I'm going to follow it. And I'm going to use this line with the candlesticks to determine the trend. However, A candlestick, depending on what candlestick has established, can give you an indication on whether the trend is changing. The gap in candlesticks open lower or higher than the previous close between days. Why and how is it caused? When trading CFDs, do we need to be concerned with this? Good question. Let's get our whiteboard. So let's say the candlestick opens at a price. The market moves up, the market moves down, and then closes at a certain level. And then the next candlestick opens at this price, and the market moves up, moves down, and closes. The part where there was no trading activity is what is known as a gap. So what are the reasons that there can be a gap? One, the stock market opens below or above previous candles movement. So this is a time issue. If something bad happened overnight with the markets and all the markets crashed in the Asian markets or the Australian markets, and then the South African market opens the next day, it has a higher chance at opening because of the futures at a way lower price than what it closed at. So that is one reason for a gap. The second reason is that there can be major buying or selling volume with one market. So if there is a certain price that the market's trading at, and then there is a huge seller at another price, and they are willing to sell at a certain price lower than what it was trading at before, there is a good chance that the market will gap. And this is sometimes due to manipulation, or that there is volume being transferred from banks to banks or billionaires to billionaires. So that's another reason. The other reason for a gap would be if there is no liquidity. If there is not a lot of trading activity, and you would see this with penny stocks. Go to any penny stock there is on the JSE market and go look at maybe a majority of penny cryptos, what I call them, or penny stocks, and go look and you'll see that there is very little liquidity, which means that there is not much buying and selling activity taking place, which is causing those gaps in the market. And you need a lot of liquidity and a lot of volume in order to make up for those gaps. All right. How do you establish the best trading strategy? There are many ways to do this, but the most important thing is to first determine what is your risk profile. How much are you willing to risk per trade? How much are you willing to risk overall with your portfolio over a certain amount of time? And then the second thing is your trading personality as to what do you want to see in front of your eyes? Do you want to follow a trending market? Or do you want to be the opposite and say, I only want to buy at the lowest price and then let the market reverse to turn up, or sell at the highest price and make sure that the market price is going to drop? Then you want to be a reversal trader. Do you want to be a continuation trader where you're following the trend? Do you want to be a range bound trader where you don't care about a trend, you just want to grab the lows and the highs within a sideways consolidation area? You need to go through these type of strategies. And what we're going to do now when we go through these 5 best trading strategies is that you're going to ask yourself and say, do I like the strategy? I love chart patterns, but I'm not going to force everybody to like chart patterns. It all depends on you. So we're going to go through these 5 trading strategies and see which one resonates with you. And then when you have the trading strategy that resonates with you, keep at it. Patience. You need patience. You need passion. You need perseverance. You need persistence. And what else do you need? Pizza. I don't know. So make sure you find out what suits you as a trader. How can you make a profit with a 16% win rate? Very easy. A 16% win rate, you can make a profit as long as your risk to reward is above 1 to 5. So let's say your entry level is here and your stop loss level is here, and then 5 times up, the take profit is up here. So take profit, entry, and stop loss. And if this is more than 1 to 5, which means that I'm willing to risk 1 to make 5. If you do this over a number of periods of trades, you will find that even with a 70% win rate, you can be profitable. If you follow a risk to reward of 1 to 2, then you need your win rate to be over 40%. If you want a risk to reward of 1 to 1, then you need a win rate of over 50%. So that's generally how it works, and why the win rate is actually a myth. Whether you want an 80% win rate or 90% or 20%, you can make profit overall. But once again, it's down to your personality, because I personally don't want a 17% win rate. It's probably an ego issue that I have. And you can send in the chat and say, I agree, I don't want to lose over 50, 60% of the time. Right. What are the best trade times for the day, less volatility? This depends on the market. If you're trading shares, for example, the best times of trading in the day is probably an hour or 2 hours once it's established the chaos that's taken place, making up for the previous night's movements in other markets, the Asian markets, the Australian markets. So 2 hours after the market opens is probably the best time to start trading. And then basically it depends on the volatility of the market that you're trading, because some shares have different personalities to other shares. And for example, Forex, they generally move more or less the same type of range, except hours of when the stock market closes. So when the UK stock exchange closes, that is probably not the best time to trade the pound. You will see that there is a lot less activity taking place, regardless of the fact that the liquidity is so high and the volume is still high. You'll see that at night, the pound is not the best thing to trade. So it depends on the market. Cryptocurrencies, there are kids in the basements trading all the time. It's not really based on anything physical, and it's more based on future applications and future trends of what's going on in technology, AI, Web 3.0. So crypto, you can trade pretty much anytime and anywhere, but we're seeing a lot of volatility in crypto at the moment. We had a massive crypto winter. I've had friends that have lost $100 million just on one crypto. So it's scary of what's going on. I'm long at the moment with Ethereum, with the premium multi-trader service, quite happy to be long. But as you know, I do not risk a lot. I do not have a lot of greed with these type of trades. If I'm wrong, I'm wrong. If I'm right, I'm right. Do you trade synthetic indexes like volatility? I used to trade synthetic indexes like volatility, but then I realized that the trade numbers that would come out were so few that it did not make up for my trading journal and whether it works or not. So I would get a signal once every 4 to 6 months. And now I use those indexes to determine or to give an idea of where the markets are more likely to head in the future. And then with those indexes, I then go look at the markets that are in the basket, and I determine the trades that I'll be taking. How much leverage? Leverage depends on the market maker. It depends on your broker. Forex, there's sometimes trading leverage of 100 to 500 times, which means that what you put in, you get exposed to 100 to 500 times more. Whereas shares, you put in a little bit of money and you can be exposed to 6 times that amount or 10 times that amount. And then we have, for example, commodities, where the leverage is 20 to 50 times. But you need to hold over 100 contracts in order to be exposed to one of them. So it all depends on the markets, really. Percent win rate, yes, that is good. I hate losing. If you're only winning, you know that your losses are there to come. So sometimes when I'm in a winning streak of 7 to 10 winning trades in a row, there is that imbalance, though, of when you're winning, and you kind of want to lose to bring back the balance with your trading strategy. Because what if you take even 20 winning trades in a row, and then the next bunch of trades is like 20 losing trades in a row? That balance of having losing trades in your trading strategy that you follow makes it feel more realistic in what you're trying to build. To lose is to win. To fail is to succeed. The only time that you truly fail is when you quit and when you risk a lot of money. So don't be afraid of losing. Embrace your losses, because it means that you are on the right track. I hope that helps. I really hope that helps. Okay. Question and answer time's over. Let's get to the trading strategies.